Many companies have joined Nasdaq by switching their stock exchange listing from other listing venues and experienced better trading quality as a result. Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Phil Mackintosh, Chief Economist at Nasdaq, to discuss why switching to Nasdaq is good for your stock. And Phil, over the past 15 years, how many switches has Nasdaq won on the U.S. equity exchanges, and what are some of the companies that have moved over to call Nasdaq home?
Yeah, I mean, that's a really interesting question. We actually did a study recently, and it shows that 76% of all the switches are coming to NASDAQ. So it's a pretty phenomenal win rate. And some of the names are really amazing brands like PepsiCo, Sanofi, T-Mobile, Kraft, even Walgreens, Exelon, and Workday. Lots of really well-known companies that have switched to NASDAQ in the last 10, 15 years. It's interesting because it adds up to $1.6 trillion worth of extra market cap in the NASDAQ market.
Why are stock listing switches a unique way to compare listing venues, and what was the methodology behind the analysis?
Yes, I guess from a statistical perspective, the problem that we run into in the research team is it's really hard to compare Apple to IBM. They're different companies. So IBM is a pretty mature tech business. It's kind of pivoted its business to doing mainframes and very much corporate services. You look at Apple, it's a relatively new company, but it's really focused on retail with retail hardware and its distribution network to sell things on the App Store and to sell things on iTunes. So they're really different companies, which means they have different stock-specific behaviors, different volatility, different spreads, different volumes, and different retail investors. So the nice thing about switches is it's the exact same ticker symbol on one listing venue before the switch and on the other listing venue after the switch. So we can compare literally apples to apples.
The data shows improved NBBO spreads in size. What does that mean, and why is that important to investors?
Yeah, so if we start at the beginning, spreads reflect the fact that a buyer wants to buy at the bid, which is usually cheaper than the seller wants to get for selling the stock at the offer. And so the difference between that bid and the offer in the market is called the spread. And it's a cost for someone that wants to trade right now because they're going to have to buy the stock from the offer, which is crossing the spread. So having tighter spreads means crossing that spread costs less. So it reduces costs for investors. Depth is also important because a lot of investors want to get big positions created. So if you can have tighter spreads with more depth, it gets cheaper to trade, to do larger trades as well. And what we actually found in the data was that once the companies had switched to NASDAQ, we saw that the spreads decreased and the depth actually increased. So it should be cheaper to trade the stock after it's switched.
How does switching to NASDAQ impact volatility in the closing auction, which is the largest daily event in the U.S. stock market?
Yeah, so I mean, we've done a lot of research on how our market's quality compares to other listing markets, and there's a really fundamental difference in the way that we work. We're an electronic market with a relatively equal structure for all different participants, and we create incentives for lots of market makers to make markets in different tickers, rather than having obligations and privileges for those that are meant to single-handedly keep markets at a high quality. And what we found is that having different views and different buyers and sellers in the market trying to keep a quote and a spread tight actually ends up with tighter spreads, more liquidity, lower volatility. There's actually some academic research that looked at the close, and the academics are able to do some pretty complex math to get around that Apple and IBM problem we talked about earlier. And they found that when you normalize for all of the different stock-specific factors, the NASDAQ close is much more transparent, which helps it have less price deviation. And we found that when we did the switches research too.
And Phil, to wrap, what does all this mean?
Well, I think when you're a company looking at a switch, it can seem like a really big decision. It's a lot of known unknowns. But looking at the data on this, you can see from actual switches, most of the stocks that have switched to NASDAQ actually trade even better on NASDAQ. They have better volatility, better spreads, and better liquidity, which should make the decision to switch to NASDAQ easier if anyone's thinking about it.
All right, Phil, appreciate the insight. Thanks for joining us on Trade Talks.
You're welcome, Jill.
And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.